What are the 5 major market trends driving the gold price right now? That's what we're talking about today. Welcome back to the channel. I'm Dave Russell and I'm joined by Jan Skoyles and Stephen Flood of the GoldCore team. And we're looking at the 5 major market trends. And we're doing it slightly different. Jan's come up with a number of topics and we have them here in our cup. We're going to pull them out and we're going to talk about them. So, welcome guys. Shall we start?
Let's start.
And the first one we have economic challenges, Panda-monium economy.
Well, I think it's pretty obvious what this one's about. I want to talk about China, focusing on the major issues that are going on and how long can the world ignore that the second largest economy in the world is dwindling, and how big a problem is this going to be, and how much of an impact do you think this is going to have on precious metals now and in the next couple of months?
So what are we talking about here?
It's huge. I mean, China, again, one of the most populous countries in the world, has, I think in one of your previous interviews, was it with Jim Rogers, he mentioned that 25 years ago they had hardly any debt. Now they're one of the most indebted countries in the world. And with interest rates, interest rate volatility, let's call it, whether it goes low or goes high or whatever happens, the stresses in that country are going to be very, very real. And then you have to ask yourself, is the administration, the government there prepared to manage an economy as it slows down? And if it doesn't, then what happens? Is there going to be, a lot of discontent, a lot of people on the streets, a lot of violence? We're looking at a Tiananmen Square type situation. I don't know. When you move so many people from the land into cities and you give them very specific jobs, and then suddenly those factories close for whatever reason, due to trade wars, due to dwindling domestic demand, higher interest rates, debt burden. What happens to those people if you can't feed them? So, China has a history of civil unrest in the past, and not too long ago. So it's a huge situation. What you do if you're leading that country and you have a problem with your people and they're becoming distrustful of you, it's great to point at a bogeyman outside of your environment. And the Taiwan Straits is looking very, very interesting in that respect. And if in your election year, do you make a move towards Taiwan? I mean, there's an awful lot of things where they're trying to distract people.
How does this impact, before we even talk about Taiwan, how does this impact outside of China? What impact is this going to have on the global economy?
Well, like I said at the beginning, this is the world's second largest economy. But just in terms of its contribution to global GDP, it was a bigger contributor over the last 5 years than the US has been. So this is a big, big deal. And China have tried to downplay how big a deal it is that's going on. So what you're saying, kind of these gentle protests that we're already seeing, or, the amount of money that was knocked off the stock market earlier on this week, real estate issues, all of these things. But yeah, at Davos a couple of weeks ago, they stood up and said, we don't plan to provide any stimulus to solve this situation. I think they're trying to downplay that this isn't that big a deal. But the fact is, this is a big hitter in the global economy and people are very, very pessimistic about it. And I think this is going to end up playing through on a number of issues. And whether it's China come out with the big guns and go, okay, we're going to show you how powerful we are via Taiwan, or supporting the likes of Russia, this is a real tipping point, both inside China with its own people and the internal economy, but also how it's going to show that it's still is owed some respect and is still one of the big players. And just on that point, how it affects us directly, in my own view, China, the biggest effect China's had on our economies is that they've been exporting deflation for 20 years. And our goods and our unit costs have gone down and down and down. And so we've been benefiting from that. And we've been able to borrow more money and inflate our own economies, counterbalanced by the deflation of products and unit costs that we're getting, and lower labor costs for products, designed in California, assembled in China. Then you're going to find that our inflation threat as we nearshore production is going to go up and up and up. And I think we have an inflation monster that's going to be unleashed. Yeah.
Bringing that back, though, to the subject at hand here, how does that impact the gold price?
Well, I think it's telling. This isn't just about the gold price, but it's very telling how much gold the Chinese government themselves have been buying. So even though they're not standing up on a podium at Davos in front of the world's leaders going, okay, guys, bit of a problem here, they are prepping themselves for an ongoing issue. And also citizens are as well. Withdrawals from the Shanghai Gold Exchange were at record levels last year. I think they've grown by 7% from the previous year. The country is getting ready for, I think, economic pandemonium effectively. So that in itself has an impact on the gold price. And we are seeing, they are taking physical off the market. And that in itself is very telling to those who use gold as a safe haven, as an inflationary asset. But also, like you said, if we're going to now see further inflation, that in itself impacts the gold price. So even if they weren't buying physical gold, this is another factor that will feed into the gold price.
Well, I mean, we're de-dollarizing, and they're de-dollarizing. They're not buying treasuries anywhere near that they used to. They're diversifying themselves from dollar risk into other things, and they're building infrastructure, Belt and roads, but they're also buying gold, and they're doing so, and they're having that gold shipped to China. So there's an awful lot of gold going from the west to the east, and has done for the last 5-6 years. So I would think that, and this is also predicated by the aggressive central bank action against Russia and its gold reserves, and Venezuela as well, where gold reserves in the international system were compromised. And so countries now who are getting ready for a kind of a multipolar geopolitical world are looking at gold as a kind of a safe haven asset for their own reserves and underpinning their own currencies. China's no fool. That's exactly what they're doing, and they're getting ready for whatever's to come.
So we've got gold moving east. There's demand
As it has
increasing.
been for a long time. It's not just since China's been struggling for the last couple of years. This is not a new phenomenon. This is something that's very much in their psyche anyway, which is to be holding gold, as an inflation hedge, part of the de-dollarization process. So, it's going to come to reward them, to benefit them in time. But this is not a new thing, even though everybody's talking about China's buying gold. Like, this has been going on for a long time. They haven't been able to export gold for a long time. They have been laying the ground for this type of situation, probably not for their own economic collapse, but they have been preparing the ground for this economic situation for a long, long time. And it's a playbook.
China is a sea in bricks, and it's a playbook that all these countries are they're not doing already. They will be doing soon. So I think gold is a massive benefactor from deglobalization. If that's a
Yeah, we'll probably touch on this one again, but let's go back to the cup again and see what we get. So next up, we've got trading places.
Okay, so trading places. What I particularly want to talk about here is the elections that are coming up this year, but the one that everybody's going to be talking about is the US election. Now, that is at the end of the year, not to come into effect until January, but what I'm wondering is how much is that going to affect policy decisions, central bank decisions, diplomatic relations, because of the anticipation of what may or may not happen in November. And I particularly want to think about what it could mean in terms of all of the upset. That's a very weak word for it, but that's what's going on in the Middle East. So Mark Farber was saying to you, I hadn't appreciated this, that when a president is sitting in office, if the country declares war at that point, when there's an election or when the changeover is supposed to happen, the incumbent stays in power. So is it in Joe Biden's interests to be shaking the apple cart even more than they already are, in anticipation of the elections coming up and him potentially losing the elections? And even without that in mind, we've got a new Republican president potentially. And what does that mean?
So I don't think it really matters who actually wins. I think the exact same policies will be followed by whoever the winner is, with just different styles. Basically, one will be more aggressive than the others. The other will be more backroom. The US is more focused now on China than ever before. They don't want to lose their top spot. And I think maybe Trump will be probably a little bit more aggressive, especially with their European allies, and the NATO treaty countries might be put under pressure. But whatever does happen, I think China is the one and only thing that matters really at this stage.
There's an interesting, you'd say that they're very focused on China there. Obviously protecting the whole reserve currency status for the US is a big thing. And really it's kind of protecting the petrodollar. And the petrodollar started in the early 70s, 73 I think it was. And that was based on an agreement between the US and Saudi Arabia to sell all of its oil for dollars. And that created what I always kind of refer to as the Great American Credit Card. Because what it meant is if Saudi were going to be selling all of their oil for dollars, that anybody that wanted to buy oil had to hold dollars in reserve. And then by holding these large amount of dollars in reserve, they wanted to get a return on it. They need to invest those dollars up until they actually buy oil. And this allowed the US to issue more and more treasuries and grow the national debt, because they always had somebody that was there willing to buy those dollars. That's under threat at the moment, and it's under threat by the emergence of the BRICS nations and the talk of a BRICS currency. But we've also now in that area, it's always been a flashpoint, but we've got increased tension. We've got everything that's going on in the Middle East at the moment. So not just in Israel and Gaza, but in the surrounding countries as well. And it's bringing it's bringing a lot of focus from the Americans on that reserve currency status and the interaction with the petrodollar as well. This is a major economic turning point for them. Now there's nobody ready to step into that reserve currency status just yet, but we're an awful lot closer. There are challengers. The idea of the BRICS currency, or even the idea of the digital yuan, and trades that are now happening for oil in currencies that are not the dollar. This is massive, though, isn't it?
Well, I think it is massive, and I think you wonder what can and what will the US do about it. You know, how are they going to prevent that from happening? Is it in the way that they generally only know how, which is, boots on the ground, military action, that kind of thing? It will be interesting. And that's where, come back to the US election. Trump is more, I would say, blunt in his approach. So will that be how he takes it? I think this year, I think it will be so pivotal how the Middle East develops. It's going to completely shift the balance of power, not necessarily away from the States, but I think we're going to see some major powers come up, and whether that's through currency measures, whether that's through resource measures, I think this is quite key, and I'm really interested to see how it will end up affecting decisions that are made on the way. So whether it's the Federal Reserve trying to protect the dollar themselves, whether it's industrial decisions that are going to be made in industry, tech, tech companies at the moment are like driving the stock market forward. I think this is such a big deal. Yeah,
you're right. And I think just to finish off on this, my big prediction this year is Iran already has nuclear capabilities, nuclear weapons. And I think that would explain some of their aggressive acts recently, in terms of launching missiles at Pakistan and Iraq, US bases directly via their proxies, and I think with 15% of the world's trade going through the Black Sea, not Black Sea, the
Suez,
the
Red Sea.
So the Red Sea. I think they have a huge point of leverage on the world's economy. But if we do go into a more conflict, King dollar might appear again. People go back to safety, and the dollar actually might become more sought after.
And if we do go into an escalated conflict, I was looking at a very interesting thing the other day, and it was actually the US debt clock. We're all kind of quite familiar with that website, but they have an app now as well. It was really interesting. I was looking at it yesterday, and one of the things that they had is they were looking at the growth in national debt by presidential administration. And you look through the years, and you can go back to the early 1900s, and you can see that the growth and the acceleration in the national debt which is fairly steady going through the early teens, 1911, 1912. And then obviously as you get into the First World War, the national debt in the US went up by a factor of 10. Now we've got a national debt in the US at this moment in time of 34 trillion. Can you imagine the implications if there is another war and that ratchets up? The same thing happened for the Second World War. The same thing has happened to lesser degrees with the Korean War, with the Vietnam War. Every time wars are expensive and money is printed to fund these wars. And that has implications for the dollar. It has implications for the US economy. It has implications for the global economy outside of the humanitarian implications, which are obviously severe as well.
And it will have major impact on the electorate. I mean, it's fascinating that given the US has not declared war, they spend the most money on military measures, of anybody. It's fascinating, and they're spending, it's an obscene amount of money. I think it's about 800 billion they spend a year.
Billion, yeah.
And they're sending all of this money there, but they're also driving down their own stockpiles as weapons as well. They're sending them, to the likes of Ukraine, Israel going on. But who's paying for it? It's the taxpayer. So the citizens, is their tax money going on it. So they're missing out on resources at home and, much needed healthcare, et cetera, But this is also going to come back to bite them in terms of inflation. And I think what everyone always forgets throughout history, we talk about, say, the Weimar Republic and hyperinflation that happened there after World War One. Everyone thinks that a war only costs those who lose. They don't think that it costs the victor. And actually, if you look at how currencies and prices were affected post-World War One and post-World War Two, the victory, the countries who won were massively impacted financially as well. So this is happening without the country even officially being at war.
Yeah. Now you say the US spending, I think it's in north of 800 billion a year on military. Here's an interesting thing. They spend an awful lot more than any other country.
Was it 10 times more than Russia, I think? Well, it was crazy.
They actually spend as much on their military as the next 13 countries put together.
Combined, right.
And 11 of those 13 countries are allies of the US. So it's absolutely massive. And it has an implication for the taxpayer. It has an implication for the dollar. I mean, what else could those funds be spent on?
Yeah. Right. Yeah. Scary times. Expensive times.
What's next?
Let's go and dip again. Goldfinger. The magic touch of gold.
We've already touched on this in terms of China buying gold.
There's a big movie thing going on here, isn't there? These names.
Maybe these are just films I just want to watch. We already touched a bit on this. We talked about China buying gold. But very often when people say, why should I buy gold? We give them all the different reasons, safe haven, inflation hedge, portfolio diversification. But I think one of the biggest reasons that has come to the fore in the last year or more is central banks buying gold. I think it's only just now being talked about, and I think it will continue into this year. The World Gold Council certainly expected to continue into this year. Was it last year or the year before? Record levels of gold were bought by central banks, and I think. Well, it speaks into what we were just talking about, wars, inflationary. We're going to see a lot more cost push inflation. So do you think we're going to see more central banks buying? Do you think we're going to see new central banks buying? Because we're not seeing a lot of Western central banks buying. The Polish bank have been buying. But other than that, do you think we're going to see it elsewhere? And how do you think it's going to affect gold demand on a lower level amongst investors?
Steve?
My God. Well, I think many people are very bullish on central bank gold buying prospects. As I said before, when we're getting into a multipolar world where you don't know who the winner is going to be or what the lay of the land is going to be after whatever period of conflict we have, you need to kind of protect your own reserves, protect your own country's economy. And the way you do that is by having a healthy allocation of gold. But in recent years, gold was always was shunned. Everyone was pinned to the dollar directly or indirectly. And as a result, there was no need to have your own gold reserves. You had dollars, and the dollar was backed by gold, in part, and it was there was a transmission of gold stability into the system. But ever since the dollar left the gold window, it's been freely traded and it's backed by nothing but taxes. And then that dollar has been printed, as David's saying, to an incredible rate. And so if we do get to conflict, it's going to be printed even more. So all currencies are basically being debased. They're all going to zero. As an individual, though, you need to almost put a central bank hat on and look at how you can make yourself financially sovereign. And by owning gold as a central bank would underpin your own finances is something that you can and you should do. too. So I do think as we go down into this election year, where I think it's maybe 40% of the world's population are now going to be voting this year.
Gosh, is that high?
It's incredible, and there's a huge amount of agonizing and hand wringing as to where we're going to go. Are we going to go more libertarian? Are we going to go are we going to go left or right of within the political system? And how are we going to deal with young people who are being increasingly, removed from the economic dividend? And so when you have so much change, so much political change, so much economic change, you've got hotspots all around the world. Does it make sense to have a hedge as a central banker for your reserves? Absolutely. Like if you're Asia, if you're any of these Asian economies, if you're European, South American, gold is a key weapon in your arsenal to protect your reserves. So I think the demand is going to actually, explode.
Well, yeah, one of the interesting things as well, not one of the interesting, one of the things that underpins this as well is when Russia invaded Ukraine, Western nations effectively weaponized financial assets. So, and we're talking about bonds, we're talking about treasuries, we're talking about payment systems. So if you held your reserves outside of your own country, if you didn't hold them in a physical, tangible asset, they were at risk of being seized effectively. So, and it wasn't just, say, enemies of the Western world or enemies of the US that had to be worried. Everybody started looking at this and say, well, this could potentially happen to us, and are we protected? Are we hedged? So there was a massive increase in purchasing of gold by central banks that are just looking effectively to do what we always say clients should do, which is diversify their holdings.
Yeah, because we encourage our clients to buy gold because we say this is a borderless currency. You can cross from one place to another if you needed to. We sit and we look at the bars and coins. Ultimately, no one really cares what's on the front of it, right? If it's pure gold, then it's good. It's good money. It's a solid, tangible asset, and it's the same for central banks. They have that. We've all heard the stories about central banks and governments moving gold around the world in times of war. It's absolutely critical asset to have during the times that unfortunately we think are ahead. And so it's a very sensible move for central banks to be making.
And Germany repatriated their gold in the last few years from New York, and if you think, the Europeans are going to be worried about a Trump presidency, and because Trump might be antagonistic towards European and traditional treaties. I think the need to have gold reserves increased and also repatriated will increase. And I think it makes a lot of sense.
Right. What's next? Just Good Friends.
Just Good Friends. I don't think that's a film, is it?
I've seen that movie.
I think it is, actually.
Is it Just Good Friends? Just Friends. Friends with benefits.
Hello.
So this speaks actually even further what we were just talking about, issues that are going on in the Middle East, countries that are perhaps feeling under threat, whether it's China, whether it's America. Where are they trying to form alliances currently, whether it's in terms of, you talked about trading institutions, whether it's supporting one another, like we're seeing with Israel, people that are supporting Israel, or support that's going towards Palestine, what's happening in the Red Sea. This is, I think we could see lines being redrawn when it comes to friendships and diplomacy. And I think that will change what the stage looks like for the next few years, massively, where support is being lent. And it comes back to what we're talking about, de-dollarization, changing the global reserve currency. So we have touched on this quite a bit already, but if there's anything else to add.
Yeah, well, I mean, I think it was de Gaulle said, countries don't have friends, they just have interests. And I think if you look at the way the world's economy is organized, probably the most powerful concept and driver of economic direction and trade winds is interest rates. And he who sets the interest rates of their currency forces all others to follow typically. And they may say, oh, well, the ECB are meeting today and they're going to decide on interest rate. Well, they're going to do what they're told. They're going to follow the Fed at some point, because if they don't, their currency is going to lose value relative to what's happening with the dollar. And then all other smaller economies tend to follow, for the most part, not in every case. So I do think that this is a question of the dollar. It's a question of interest rates. It's a question of conflict and debt, and then these alliances that come forward. And I don't think China's Belt and Roads is going to pay off, and they're going to create this empire of trade and infrastructure, maybe inside the BRICS countries, and maybe that's the new East versus West. It's the BRICS versus the G7, and that's going to be the map that's going to be decided, which is an entirely new area of conflict, and it's really difficult to try and understand how that's going to manifest. But I think the interest rates are important, debt's important, and obviously these conflict and hotspots.
Yeah, the flashpoints now that the massive increasing of tension in the Middle East is going to be a real determinant of lines going forward.
Yeah, I think it is. And I think but we also look back at how relations were built hundreds of years ago to do with trade, right? And I think we're now seeing quite an interesting change in the way that trade's being done, whether we're just talking about to do with the dollar, but also the physical way in which trade's being done. The war in the Middle East, let's be honest, is happening mainly because of resources. Whether it's to do with gas pipelines, whether it's to do with access to oil, we're now seeing supply chain routes having to change because of what's happening in the Red Sea. I think all of these things are going to massively impact how countries want to do business with each other, how companies want to do business with each other, because let's be honest, companies often have more weighting than the countries in which they're based. So obviously interest rates play a huge part, but I think we're also starting to see a bit more of the traditional means by which we used to form relationships come into play, which was ultimately about how we trade with one another and do you have something that I want, and how can I get it from A to B. I think those are going to really impact things, because when companies can't get their resources, or when we can't get food, that is a big deal. It's not just about what our central banks are doing.
And just as you're saying that, I was thinking a big component of this is going to be the environmental policies that are now coming through. So you've got, carbon costs. Companies in Europe are being required to understand and account for their own carbon expenditures for what they do, and that's scope 1. And scope 2 is they have to account for their suppliers who actually give them the raw product for their products. And scope 3 is they have to account for the carbon costs of their suppliers. So the entire chain of production, the entire value chain is now going to be accounted for. And that means is that you're probably going to have to produce products more locally to the market that you sell them in. So that's nearshoring as well, which actually is quite useful from having reducing your exposure to, let's say, China, if that's your problem. And if you don't have a reliant on markets that are far away, then your alliances don't matter as much for those economic actors. So maybe what you might find is there's more of an insular approach to economics, because we're nearshoring everything for environmental reasons, and then we don't really care what happens, economically to those trading partners of yesterday. So that actually means that there might be more fracturing going on in the
breakdown of globalization as we currently know it.
Hugely, yeah.
So again, to bring it back to the topic of this conversation, how's that going to impact the gold price?
Just buy gold.
Yeah,
It's just such a big level.
I just think change, gold tends to do, when things are okay, and politicians tell the truth, and bankers are nice people, and they actually lend money, to worthy companies. Gold price, gets ignored because you don't really need a safe haven asset. The insurance premium that gold brings is not as valued, so it tends to go sideways. It doesn't tend to fall very often, but it tends to go sideways. But when things get a bit hot and change and volatility is the norm, and there's new alliances being developed, and wars and climate change. You pick it, there's so many different things out there. Gold is sought after by investors looking just to protect their portfolios from the unknown. It's really kind of like what I call a contingent asset. Its value comes from contingents as a contingency to the unknown that's going to come down the tracks.
I think much of what we're talking about now is because of the war that is building and these hotspots that are going on, and war and gold generally, because it acts like a safe haven. People are feeling uncertain right now. I don't think over the next couple of months the gold price is going to be hugely affected by what is happening in the Middle East. It's a situation that we've now been living with since October, but how it's going to flare up. But I think people are going to be holding on to their gold in anticipation of what is going to be happening over the next few months and how the rest of the world is going to react to it.
Finally, we have paradoxical central banking.
How are central banks telling us that they've got inflation under control, and yet meanwhile we're seeing economic releases coming out that suggest it's probably not as under control as they think it is? We also have a cost of living crisis. We've got farmers protesting in France and Germany. We were talking about debt earlier on. Has anybody heard on any of these election campaigns anybody talk about paying down the debt? But meanwhile, the central banks are like, look, we're getting ourselves back in a strong position here, guys. But then the paradox really is something we've already touched on, which is other central banks meanwhile are buying gold. So it's almost like they kind of do as we say, not as we do, kind of going on. So are central bankers going to confront the realities of what is really going on this year?
So we're saying then, the most recent inflation number out of the US is saying that inflation was about 3.4%. So it's come down from the high. So are we saying that we don't believe that?
I'm saying that you can make any number appear how you want it to appear depending on what you input into it. That's what I'm saying. So if you're talking about core inflation, that's interesting, isn't it? Because that's not really counting external factors, because it doesn't include food and energy. So what does that? What is it? What does that number really? What is that really reflective of? And then is it really reflective of what the guy out on the street is feeling? Is it really reflective of the single mum who's got to feed 2 kids on 2 wages? Is that really reflecting her reality?
This is the thing that I don't think most people appreciate. Is you see a headline number, 3.4% inflation, and you watch that month to month. It's up, it's down, but not everybody experiences that level of inflation. If you're a lower income, you're in a fixed income. Food and energy, the things that are excluded from core inflation, make up a much larger part of your household expenditure. So if you do get a spike in food and energy prices, if you do see the oil price significantly higher, that impacts a lower income family with less disposable income much more than it does, say, a retired couple who have their home paid off and have a larger disposable income. So the 3.4% should not be interpreted as being everybody experiences 3.4% inflation. And I suppose another thing on that's 3.4%. Their target is 2%, right? They're still way above their target. Even at 3.4%, they're still way above their target. They've come down from 8-9%, but they're still way above their target at this moment in time. So the inflation is not under control, no matter what they say.
It's not under control. And I think it's, inflation, if we're talking about an election year, nobody cares about that headline figure. They just care about their day-to-day experiences, like you've just been saying. And I think this is potentially... This could be quite, you were talking about protests in China. I mean, all around the world, people are struggling. Not everybody's struggling, but people are feeling the pinch, on the majority of levels. And I think central bankers, it was Jim Rogers said there's a reason why they're in government jobs. They're not like the best at this, guys. Like, if they were good at what they did, they wouldn't be central bankers. So at what point, how long are we going to keep believing that central bankers really believe their own figures? And how long is it going to be? Are markets just going along believing that inflation is coming down, even though we ultimately all know that it's not coming down?
I just think that even from the financial press, Bloomberg or CNBC, the amount of signal that they take from central bankers now, whereas before they were kind of like, they were looked at whenever they met, and then it was the market fundamentals that were talked about. Now it's like, what are the Fed officials saying? What are they doing? What are they, what way are they holding?
Did he scratch his nose?
What way is he holding his case? And the press conference is all all powerful, and the signal and the verbiage used. To me, I think they pretend to be, the princes of the global economy, and they're looking at the book tour after they leave office. This is where they get paid extraordinary amount of money. I think Fed Chairman Powell, I think is he worth like $80 million or $100 million? Like, he's so divorced from reality as far as I'm concerned, in terms of those people that you're talking about who really feel core inflation. But ultimately, I think the United States has so much debt now that they're spending $800 billion on defense. But is it $1 trillion now on interest rate payments?
It's nearly as large as the military spending. It's about $750 billion.
Just to service their existing debt, which is growing at an exponential rate. Like, that debt clock of 34 trillion. When you said 34, last time I checked, it was 32. Mm-hmm. I don't know if that was at the beginning of this podcast.
Next time we should just have the clock in the background.
I mean, it's just nuts. I mean, this is monopoly money. But ultimately, the more debt they have, the lower interest rates have to be in order for them to service that debt. So they're actually running out of options. The decisions and choices that they had before are being taken away from them by virtue of the amount of debt that they have. So they don't have any choice but to keep interest rates low. And by keeping it low, that drives inflation up. And so inflation, if it becomes from any other quarter, if it comes from a crisis in the energy markets born out of the Middle East and conflict there, that inflation shock is going to come across, and they won't be able to tackle that without even printing even more money.
So and that's an interesting point that you raise. There is a significant amount of that 34 trillion that is due to reset in 2024. And I think the average length of US debt's about 75 months. It's about 6 or 7 years. So if we look back 6 or 7 years ago and we said, but where was that 6 or 7 year equivalent interest rate? And it was at about 2%. It's now the equivalent is about 4%. So that debt that's going to be repricing this year is going to be at an interest rate that's twice what the debt is rolling off at. So without increasing the actual debt, they will be significantly increasing the annual repayments on the same amount of debt. And I always think back to my parents when they bought their first house, early 70s, and it was I think it was about £7,000 at the time. And they sold that house 25 years later, and they sold it for, I think it was 95,000. It was a massive inflation in that intervening time. And that had a number of impacts and implications. They used to pay £100 every 3 months was their mortgage. And when they bought the house first in the 70s, that was difficult to do. But when it came to the late 80s, 90s, that was a lot easier. And why? Because there was massive wage inflation as well. We're not now, and that's how they were able to effectively inflate away that debt that was there. We're not seeing that same wage inflation. We've got all of the inflation, but we haven't got any of the wage inflation. And that's probably yet to come, because the only way that governments can live with this increasing debt year after year after year is if they inflate that debt away. So they need inflation in order to be able to inflate that debt away. But they don't want to be seen to be creating inflation. So they need lower interest rates to be able to create inflation, but not report the real number. And they need lower interest rates as well, because if they don't keep interest rates low, as Steve says, you're massively increasing the debt burden, because the repayment, the interest alone is soon going to become the largest item on the annual budget.
And just one really, really interesting point is if inflation starts to really take off, those who have assets will benefit massively. Those who do not will lose, not only lose, in terms of their income, but their expenses will go up. Their income will go down, if not be removed completely. And the inequality that has been building, so much in recent years will just get worse and worse and worse. And then those people will vote en masse for the most extreme political options, which may come in and, God knows what they'll do. Despotic regimes popping up in different places in the world, and maybe even the United States. So it's a very precarious position, for the population. I think Ray Dalio had this great chart there a while ago where he looked at the percentage of wealth that was held by the top 10% versus the bottom, 50%, and I think it was like 30% now. It's equivalent. The last time this happened was back in the 1930s, and then that led to World War II. And the world changed forever. So I think these Fed officials, ever since the 1990s, have been micromanaging interest rates to such a degree. They've massively enriched Wall Street and people who own assets
and themselves,
and at the expense of the regular man. And I think if you look at the actual median, which is a great way of looking at stats, income of the average American in the year 2000, I think it was like $32,000, and now it's approaching $35,000. So in 20 years, they've had a pay rise around 8%, but the average house has gone up threefold, and the average car has gone up, 2 or 3 times. So they're being impoverished. But what they've done is they've replaced that with debt. So the average person's interest rate sensitivity is very, very high as well. So yeah, it's a very precarious position.
Just to quickly bring it back to gold, we. Just from Steve's conclusion there, we've got a good idea of how that will impact gold. But in the short term, what was interesting last year is whilst markets were paying attention to how Jerome Powell carried his briefcase into the briefing room, actually gold became less and less reactive to what was coming out of those central bank decisions, which I think was quite fascinating last year, was what really was driving the gold price. For a long time, everybody like, we've got to look out for this central bank decision, this will affect the gold price. But actually, it would maybe have like a little bit of a reaction, in the following hours afterwards, but then it would just carry on with what it was doing, just like it didn't really react to the ETF outflows that were going on. Gold
is decoupled from interest rates at the moment.
Yeah, and I think that over the next few months will be interesting to see whether that becomes a trend. Yeah. Because I think that also shows how markets are starting to change their opinions of gold and what it's here for.
So that was paradoxical central banking. Have the central banks really got inflation under control? Just good friends as we are redrawing the lines of traditional friendships and trading relationships. Goldfinger, the magic touch of gold, the role that gold will have in portfolios going forward and why it has hit an all-time high. Trading places, which is the elections. 40% of the world going to the polls this year. What impact is that going to have? And then finally, the economic challenges, Panda-monium economics, the changing state of the Chinese economy. We've seen an increase in geopolitical tension. We've seen an increase in economic uncertainty as well. And all at the same time, we're seeing gold doing what it does, and it's hitting a new all-time high as we see that increase in uncertainty. That's been a fascinating conversation. My thanks to Jan Skoyles and to Stephen Flood. If you've enjoyed this, subscribe, and if you want to continue, have a look at this video here. It's a very interesting interview that I did recently with one of my favorite guests. And if you're interested in learning more about buying gold and silver, log on to GoldCore.com, your precious metals experts.